investing YouTube channel. And I created this channel more just to help people on their journey. And I have like a very interesting perspective on the markets that I feel like other people should know. And I think it would be helpful to many other people. You don't have to copy what I'm doing, but maybe you could like take some inspiration and maybe tweak it to your own ways. So I just want to talk about like how I'm gonna set this up. So basically, I'm gonna talk about like investments. So this is mostly gonna be on the stock market. So basically, I'm gonna talk about how investments I like, and I have a mini portfolio right here I'm setting up so people can see in real time what I'm doing and what I would buy today. Because I feel like the transparency is really important, and I don't see many people with that transparency and actually creating real gains on the market. So I've really just created this account recently and mostly loaded up the money recently. So I'll be doing more to like, I guess I just like put in money into investments. So I guess we'll see how they play out from now, and you can just see how my strategy goes and if you guys like it or not. So I would like to talk more about the strategy. So I would say the reason I named the YouTube channel Horse Racing or Horse Race Investing, because I think picking stocks is like picking a horse. So when you're horse racing, when you're gambling horse racing. So I guess I would say like the perspective I take is how much growth there is in the business is how fast the horse is. And the valuation you pay for the business is how injury prone or reliable the horse actually is when it runs in the races. So this is another thing I also a main mindset thing I think about. The stock market can either act as two things, either as a casino or an auction of businesses. So here, our strategy that I'm going to use with this account is I'm going to use the auction of businesses as an edge in the casino. So this will work in practice. So I'll try to find high quality undervalued businesses that I believe in the long run are like that will do good, have long growth runs, and not overpay for them, right? And then what we'll do here, because we're this is more of a smaller account challenge, I guess. We're gonna use options to maximize our gains by getting control of as many shares as possible to maximize the gains. There is a higher risk with this type of strategy. That's why I'll use an account which won't ruin my life if I lose money. But I'll say we have an edge here that I believe there's an edge. So I believe I will make money. But I will say when you're doing any type of strategy that's a little more high risk, like the goal it would be probably just to like buy the stocks outright without options, but here we're going to use leverage so we can make more money. But I would say if you're not okay with losing the money, just buy the shares outright and just like you'll probably be safer that way, but you won't have as much to gain long term and lose less if it goes bad, right? So here, why I'm choosing options too is, let's say I could diversify more instead of putting all of them into like one stock, because I'll get the leverage. So basically, instead of buying like maybe one or two stocks, I'll maybe have three or four, right? So with the beauty about options is, since there's a good amount of leverage and you can only lose what you put in, the best part is, let's say I only I'm only right, let's say one out of three times, let's say on a conservative note, right? Even if I lose the other two go to zero, I'll still make money overall because the third one will go up more than 300% if it's right in the long term, right? So here, my goal is to pick the best horses and hope the market agrees with us in 2 to 3 years. Because in my opinion, when you pick like stocks and the market really doesn't agree with you in 2 to 3 years maximum, you're probably not, the stock's probably not a good pick. So I don't think like, so basically our goal is to get the longest out expiration as possible we can buy, and then the market agrees with us over time, and then we flush out our gains or roll the options. So that's probably the strategy here. So I'll show a few of my stocks in the portfolio I have right now, which I believe are good long-term holds. So right now I have one call of Ulta. So that's Ulta Beauty. So basically they're more of a beauty company, and oops. So here's Ulta Beauty. So the good thing I see here is, let's say you see the 1 year price. Let's see the 5 year. So overall, let's see like the max. So you see over time, this is a long-term compounder, right? We can go on macro trends, and we can see Ulta Beauty. And we can see there's a lot of revenue growth here that I was looking at. So over time, there's been a very good amount of revenue growth. Let me X this out. Okay. So we see a lot of revenue growth here. So we can see like each year there's about 20% on average growth. So except for COVID, obviously, when everything shut down, and there's a re-ramp up after COVID. So we see like it's averaging right now, it's about averaging 10 to 15% growth. So like that's really good long term. And one thing I really like about the business right now, because the share price has fallen on basically what happened was there was an earnings report and they grew less than expected. They still grew right around 10%, which is pretty good, but Wall Street expected more. So one thing I really like about the business, that's a quality of these long-term compounders, which I'll give in another example. Let me think of another example. So I'll show Ulta first. So basically, they're buying back stock like right now, since the price has dipped recently. If you look on the 1 month, the 3 month, it's dipped a lot from around 560 to around 420. So that's a good dip, maybe like around 25%. So that's or 20%. So that's a good dip. But we see right now, since the share price has gone down, they've been really buying back stocks. So that's like a quality of these long-term compounders. So there's another one I would show, O'Reilly stock. Actually, they have a competitor that does it even better. Let me look for them. AutoZone, yeah, that's what it was. Yeah, so AutoZone, they do this very well in the way they buy back their stock. So, okay, that's the ticker. Okay, we'll go to them. So basically, these share buybacks, it will push the price up because there would be less shares outstanding. So the price would be pushed up. So you see over time, let's say over here since 2012, they had about 400 million in shares, or 40 million shares of shares outstanding, right? So right now they have less than 20 million shares outstanding, right? And that's like cutting it in half. So that means the stock price should double if the fundamentals are the same, because you own double of the business that you would own. Because like, let's say you own like half the pie, or let's say you owned 1/3 of the pie, now you would own 2/3 of the pie. That's very useful long term. And then as they keep cutting it down, it'll get better and better. So let's look at the share price long term, right? AutoZone is not like some like AI company or revolutionary, but their share price has done very well in the long term. Since even 2020, let's say here, or 2020, $1,000, now it's $3,000. So it's very good if you can execute the strategy properly. But the biggest things you want for executing that share price properly is a long-term situation why your stock is cheap. AutoZone was cheap for a long time because people thought, people will start repairing their cars less. They'll switch to EVs. People won't need to use them as much, or cars will get better and they don't need to be repaired as much, right? So they stayed cheap for a long time. So when they bought back stock, they could buy back more with less money. So that's what we see here with Alta too. We see only a 14 times forward PE, which is very cheap for the industry. And the best thing about beauty is that it won't go down really ever. Like it all compared to all the industries, I think the beauty industry is a very stable industry that will outperform long term. And there are also managements thinking about international expansion, which can be really good long term, right? So you can see extra growth long term. So that's one of the stocks that I have belief in right now. So I placed a good amount of the portfolio in Ulta Beauty, and I believe that's a long-term compounder. What else do I have that I really believe in? Okay, so Humana. So this is more of an interesting one, right? So this is more a play on healthcare. So, okay, so this is more insurance company, right? So I see right now a dip in insurance, and mostly it's been Humana and United Health, right? I have both of these. I have United Health in a different portfolio too, but I feel like Humana has a lot of upside right now because like Humana, like most people have already missed the boat. Like I think in the other portfolio, I was buying right around here. I didn't get the bottom, but right around here. But I would say United Health will recover a good amount faster because it's just the bigger company. I would say it's even higher quality, but I wouldn't say on a long term what's cheaper and who can like buy back more stock. I would think Humana here because right now Humana is more of in a pickle than these other health insurance companies because right now people don't want to invest in the government, the healthcare companies that work for the government and government contracts because they're not raising their prices that much, or they're not letting Humana raise the prices, and they think it's all of a sudden now a bad business. So as you see, let's say Cigna, they were thinking of buying Humana. There was like a agreement to buy them. Then the stock dipped around here because the shareholders didn't want them to buy Humana. And then Humana was rising here because they wanted to sell the business, right? It was rising right around here. Oh, let's sell the business around here, right? So, and it was for a good price. But then Cigna backed out and they announced share buybacks. And then immediately price went up 15%. I actually remember this. I was thinking about putting an order around here, but I wanted to wait one more day. And then it went up 15% on that buyback announcement. So, and I would say Cigna is not affected because of they're more on the business side. They connect with businesses in the healthcare sector. So I would say Cigna, that's why their stock price has stayed up. But I would see like right now Humana's down around 40% from the all-time high. And the good thing about Humana, I would say the only problem right now is short term. There's a problem with their profitability, but overall, okay, let's see this. Okay, so here, one reason to really like Humana right now is if we still see strong revenue growth, which is very important in the sector to keep the government contracts, right? And I think that's more important than just like trying to beat the street and just like get more profitability right now. So people are looking down on Humana. So let's see the net income, right? So basically it has gone down a lot, or like into like the negative for one quarter, but analysts have expected basically EPS to drop 50% this year. It was like they wanted 32. Let me get another tab of Humana. Shoot, can't type. Okay, so basically analysts were expecting around 32 cents or $32 of profit or EPS, but they came in saying they may only make 16 this year, which is pretty bad, honestly. I'm not going to lie. But the thing is, over the next year or two, they'll recover that EPS very quickly, and next year. And since, okay, the stock price has fallen like 40% like the earnings, But once they recover, the stock price will have to come up because this is a very high quality business in general, like healthcare and insurance and healthcare. I would say a similar situation to this because people think right now, oh, the business model is changing, it's really bad. And overall, in the long term, it's always worked out well. I don't understand why people think, oh, this time's going to be different, it's going to be really bad. And I would say another situation I feel like before that kind of signals the same situation as today is Netflix in around 2022. Okay, yeah, 2022, when the stock price dropped. How much was this? This is around 70%, right? And I think the problem, people are saying, oh, streaming's not a good industry. There's so much to spend. It's not a good industry. Oh, like the doubts were all coming in then, right? So that's when people like us should get into the stocks if we believe in the industry. I personally believe that the insurance industry and healthcare will be fine long term. And even working with the government, I like it a lot. I think long term, the price increases will come back and they'll be able to make cash flow. So that's why I believe Humana, I bought 2-year calls, and I think in 2 years, the market will understand and get over why Humana is a good company and why Wall Street shouldn't just be dumping all their shares, right? So what's another stock I have? Okay, PayPal. This is where I have a small amount of money, and I would say overall, PayPal, it's more just like I'm more into it because they're very cheap right now, honestly. So I would say like PayPal has I actually watched some of the new CEO talk about what he's trying to do with the business. So I actually like what he's doing a lot. I think what really hurt PayPal a lot was buying these different acquisitions that really didn't fit into the company, or they fit into the company like Braintree and what the stuff they bought, but they could not monetize it. And example like Venmo, they have Venmo right now, really big, but they're just not able to monetize it right now. So this CEO is like, okay, let's stop the acquisitions. Let's try to monetize what we have right now. And that's very useful for shareholders. So as we see, the forward PE is only 10, 11. The free cash flow is very strong. Let's go to macro trends again. PayPal. And they have a lot of excess cash they can spend, right? Since their share price is down, this is what they're doing. They're buying back stock, which I really like, which they really haven't done really before at this scale. And they're going to spend more if the share price stays here, because their cash flow is going to go up as they try to be more efficient. There have been some layoffs, which is good with a bloated company. So I really think this has some real potential to maybe even double, because I would say like this sector, because if you look, let's look at, not the screener. Let's go to home. Let's go here. So this is the day. This is like the overall charts, right? So you see where, So you see where PayPal is here, right? Or let's go on a forward P. You see like where PayPal is here. It's trading around how much these credit service providers are, and not like, they're more on the side, I would say MasterCard and Visa, of how they do business than like a Discover or a Capital One. And they're trading like a bank, which banks are very leveraged and risky. I would say PayPal is just like in the transaction and just taking a cut. So they're more like Visa in this way. So I would say their valuation is dirt cheap for who they are. And people have just like given up that, like basically what happened let's look at PayPal's like stock chart. This was the big problem that caused the bubble here, kind of, I would say. The big problem was margins were going up. Actually, I'll show you guys, actually. I think that would be better. So let's look at margins. So profit margins, Okay, so gross margins, they were going up here. And the CEO said, oh, they'll keep going up. They'll keep going up. And he hyped up, oh, we're going to have 30% revenue growth and all this stuff, right? And then Wall Street really was like, oh my God. Then this is crazy, right? And then the stock just started pumping from like here to like, it almost tripled. Yeah, it tripled. And then gross margins started coming down. Like, this is very bad, right? So this is the problem. If the gross margins are going down, there's almost no way the stock price can really go up, because it just shows that like the business isn't as strong, because they were growing revenue through sectors that weren't as profitable. But right now you see like the net margins are coming back up, and the new CEO, I think he'll bring these gross margins back up, because I think they've like bottomed out around now, because it was declining very quickly. Now it's kind of like slowed down in the way. So like it could start turning the other way, and then you immediately see a pop in the share price because it's so low. It's lower than it was at the bottom of COVID. And overall, like I would say compared to Square and stuff, this is a very profitable company. So like I think this has more upside than like Square and stuff, which is diluting shareholders and stuff like that. So what's another? I think I had another one. Okay, I have Pinduoduo, or I don't even know how to say that one, but this is a Chinese stock, right? I think you guys know more of it as, I think I'm more into this. This is a very small position in the portfolio, but I would say I'm more into this because they have their Temu that they haven't even really like made profitable yet. And I've read some of their earnings calls and listened to the earnings call and read the reports. I really like this management team on how asset light their business is. So let's go on Seeking Alpha and let's go PDD. This is no. Okay. So let's go to PDD. Okay. So let's go to the balance sheet. So you see how asset light this business is. So you're going to see like how much, I'll show the revenue first. So this is making $34 billion of revenue each year, and it's making profit of around $8 billion right now. So those are really good margins. And the best part is they haven't even made Temu profitable. They're giving a lot of free stuff out. They're doing a lot of advertising. They're not making it profitable right now. They're looking at the long term. And there's so much growth there. And right now, you see they only have $700 million worth of equipment and stuff, or net property equipment, like factories and stuff like that. They're really like, how they're doing it compared to other companies is they're letting them do the manufacturing. They're letting like the third wholesalers doing all that stuff, and they're just investing in the software and making it the best. Let's look at a competitor like JD.com in China for what they're doing. You look at how asset heavy they are compared to. You see how much they have $14 billion worth of net property. And then let's look at Alibaba. That's about the same market cap now. And the problem with being so asset heavy is that you're going to have to pay for so much more of these factories to expand, $25 billion in factories. And this is making the same amount of profit with only $700 million. And it's very hard to grow. They can easily double their manufacturing without spending that much. Alibaba, these companies, they might have to pay 25, 30 billion more dollars to build factories to be able to double their margins. So overall, PDD, they're doing very well right now. And I don't see the growth for Temu stopping. I think they're like, let's see this monster growth. 93% year over year, then 123%. I know this can't sustain, but even if they just grow around 20 to 30% for now, their stock price will increase a lot. And this is the crazy part why I got into stock. Basically, they had this earnings report, which 123% year over year growth and 26% net profit margin, which is really good, right? And it's crazy growth. This is really fast for a company this large. So this stock, I think the earnings was like around here or something. And pre-market, it went up to right around 150 or something like that. It went up like 18% after hours, right? But then like, as the day went through, it just came back to like almost break even, and now it's like gone down. So I think like people just like forgot about how good that earnings report is. So I think it's like a really good time to get in now. And I think it will go over the February highs. And I think it's definitely possible because back then there wasn't even a Temu and stuff. So if they like really get the margins in and execute well on that, and this team is really good at executing. So I think there's a good chance they do really well and keep doing what they're doing, right? Because they've grown so fast. They only founded in 2015 compared to like, and they're almost as big as Alibaba in market cap. And like Alibaba started probably like, I think 1999. Yeah. So like in a small amount of years, almost 9 years, he's grown his net worth a crazy amount for PDD. So I think these are the 4 businesses I really think are good deals right now because the market has gone up a lot. So you have to be very selective on the deals that we're paying. And I think these 3 will do very good long term. If any of you guys have any other stock recommendations or stocks you want me to check out, I can do deep analysis on them and I can give out like what I think and stuff like that. And thank you guys for listening and I appreciate your time. Have a good day.